Good evening and welcome to tonight's show. I am your host, Tina Dawson, and I'm the owner of True Blue Designs. And it is truly an honor to be before you this evening. Please like, share, and tell everybody that we're on the air. We are broadcasting simultaneously on Facebook, on our Facebook page, and on our YouTube channel at True Blue Designs. Now, I am very excited about introducing tonight's guest to you. A couple of weeks ago, we had on Sherry Pope, who is a home appraiser. And we discussed that currently we are in a seller's market, which means that there are more homes on the market than buyers, right? And buyers are in a bidding war. Some buyers are bidding $10,000 to $20,000 to $30,000 over the asking price just to win the bid. It is a frenzy out here. And there are a lot of things that you can do yourself if you're looking to buy a home to get yourself ready to make that purchase. Also, if you're looking to sell, now is the time because the market is right. Now, tonight's guest is someone that is dear to me. I have done quite a bit of deals with her, and she knows her stuff. And I just cannot wait for you to hear what she has to say. Make sure that you leave comments, welcome her, let her know how you enjoy the information. But also, if you have a question, put it in the comments and she'll make sure that she either, if we can't get to it tonight, she will get to it within 24 hours. But she is here to discuss the basics of mortgage lending and to give us some tips on things that you can do yourself to prepare for home buying. So right now, please give a warm welcome to tonight's guest, Miss Kerry Sidberry.
Everybody doing out there? Hey, how you doing? Awesome. Good to see you. Good to see you.
Good to see you too. Thank you so much for being on the show.
Absolutely. Thanks for the invite. It's always my pleasure to anytime you call on me, whatever you need, I am here to serve. Okay. And you look marvelous tonight too, by the way.
Thank you. Thank you. You look fabulous yourself.
Thank you. Thank you.
I can't wait to see you face to face though. We gotta
right. The pandemic thing. Yeah, exactly.
So as I said in my intro, a couple of weeks ago, Kerry, we had on a home appraiser. And so many people had questions. And I said, okay, I got to bring on a mortgage lender. And who came first to mind was Miss Kerry Sidberry. So I had to get you on the show. And thank you so much for saying yes and carving out some time to be on the show. I really appreciate it, Kerry.
Absolutely. I enjoyed that show. I did see the show.
You did?
Yes, I enjoyed it. Lots of great information. She was very knowledgeable. And yes, I'm just happy to, be able to piggyback and add any value I can. And thank you for this platform, to help others.
Yes. The goal is to educate and inspire.
Well, you got me inspired. That's for sure. So
okay,
it's working.
We're going to start off by allowing you to tell the viewers a little bit about yourself.
Okay, great. Well, hi, everyone. Hello, beautiful people. Listen, my name is Kerry Sidberry. I'm a mortgage loan originator. I've been a mortgage loan originator since 1998. So I guess that's what I'm in my third decade. No, over 20 years now. And it's a lot of fun. It's been a very adventurous ride. There's no 2 days alike. Yeah. I was originally born in Jamaica. And yes, Yaman, and grew up in New Jersey and came to Georgia to go to University of Georgia. So I'm a Georgia Bulldog, right? And lived in other places. I've lived in LA, I've lived in Miami, but man, there is no place like ATL. And this is my home, my forever home. And I got into the mortgage business, like I said, in 1998. I was in a car business. And what made me get into the mortgage business, I studied consumer economics at the University of Georgia. So I was familiar with economics and finance and budget analysis and things like that. And I just felt like, I rose to the top of being one of the top 13% of salespeople very quickly in all of the United States for the dealership I was working at, Honda. And after a while, I just felt like I was putting people in bad debt, and mortgages was very appealing to me. When someone asked me, well, a lot of people in the industry were going to the mortgage business, and it was very appealing to me because I felt like, okay, if I'm going to put people in debt, I'd rather put them in bad debt. So for me, mortgages is my passion, but I also like helping people to make decisions. Buying a home is one of the biggest, if not the biggest decision that someone is going to make. And I feel like it is my responsibility to be in this space and be an ambassador for good decisions and getting people into something that is going to work for them now and in the future, and even create a legacy for their family. So that's why I'm here. So I'm happy to be here. And thanks for allowing me to introduce myself.
Yeah, they gotta know who you are.
Yes, definitely.
So let me ask you this though. So do you have any advice for anyone that's looking to get into the mortgage profession?
Absolutely. If someone's right now, the average age, I don't know the exact age, but it's over 50. I think it's around 54 to 58. That's the average age of a loan officer, mortgage loan originator, mortgage broker today. So we're going to need people to come in to the mortgage industry. So if you're a person that likes financing, likes budget, likes people, you don't even have to know anything about numbers, likes people, you should definitely consider a career in the mortgage industry. You do need to help people with making decisions and be a bit organized, because there's a lot of details that you do have to pay attention to. No two loans are alike, and you have to be looking at everything, So I encourage you, if you are interested, to definitely take a look.
So what do you think about this seller's market?
Wow. First of all, this is my third official crisis. And when I started in 98, we had a crisis with equity lines where people were purchasing homes for 125% of the value of their property.
Wow.
Yeah. Your house was worth $200,000. You say, oh no, it's 125. You can borrow against 125.
Wow.
That crashed. And then we had the big market crash in 2008 that everybody knows about, where the stock market lost 39.4%. And then now this is another crisis, except it's inverted. We have a shortage of homes, and the prices of homes have skyrocketed, which means for people that are already homeowners, that's great because they have equity. But this is a challenging market for people that are looking to purchase their first home. It's not impossible. It's challenging. So it's very interesting. It keeps us very busy. And I've never seen anything like this, because this is the first time where we had a rush of refinances and purchases at the same time. It's usually one or the other, So this seller's market is quite unique and tiresome, but when you love what you do, it's not a job and it's not labor. So it's interesting to see how everything will pan out in the future.
Yeah, and I'm glad you mentioned that, because I had read a couple of articles that mentioned that the bubble burst is going to come. Because of everything that's going on, and people bidding so much over the asking price of the home. So what's your take on that?
Thank you for that question. My take on it, I know there's differences of opinion. There are people out there waiting for that bubble to burst, waiting for this massive foreclosure, scared of massive homelessness so they can go and purchase property. But in my professional opinion, I'm speaking, of someone that's been, like I said, this is like a third crisis for me, and been through two crashes. People are basing that on what happened in 2008.
Okay.
One of the things I studied was housing in college. Okay. You have to take a look historically at housing since mortgages were introduced post-World War. Mortgages were introduced. We never had a situation where homes were a depreciating asset, where they went down in value. Homes have always gone up in value, except for some places in California, they did experience up and downs.
Okay.
So what happened in 2008 was you had basically false information. There were portfolios of loans that said, hey, we're doing great, when they were not. Right. Then you had very, very loose guidelines. We had loans where people, if you could fog up a mirror, basically, and you had a high credit score, you can get a loan. No doc, meaning you better not put do not put a job on that application. You just put their name, address, date of birth, and social. That's it. And they can get a mortgage loan. 100%. investor loans. So you have people that had 2 and 3 and 4 properties and didn't have any skin in the game. They didn't put anything down. So that's why we had the crash of 2008. As opposed to now, we have a shortage of housing. We have a lot of people coming into the market. Yes, prices are escalating, but I, in my opinion, don't think we're not going to see what we saw in 2008.
Okay.
There will be some foreclosures, but it's just going to give the people that are waiting in line an opportunity to purchase homes. So I encourage you, I know it's a little rough, but don't wait. This massive thing, I don't think it's going to happen, because the loans that are out now, they are underwritten with care, meaning as much as people had to do to get into a house, you best believe they're not just going to let go of that house. You know, whether it be paperwork or how much skin they had in the game. So I don't think we're going to see what we saw in 2008. If anything, you will see where the bidding wars come down a little bit, where, hey, let me give you 50,000 over, 80,000 or whatever. They may come down where you can look at a house and say, okay, they want 250. I'm gonna give them 250.
Right.
But I don't think we're gonna see, that 250 house for 150. Those days are gone. Just like gas prices never went back down to 99 cents. I don't think real estate's gonna go down again. Not like that.
they need to.
I know they need to. I need to. But so we will see a progression of homes going up, different parts of the country, especially in Atlanta. If something does happen drastic, Atlanta will be probably one of the last places to actually feel it, because of the location and all the IT jobs that are coming here, the financial job. It's just the airport, everything that's here. You're not going to see much. So
right. I was talking to a real estate broker last week, and she was telling me about an agent who listed a house. And, now the listings have quick, we're going to show it. We're going to have an open house for 2 days. And then the third day, we're going to review all offers. And then we'll make our decision on the fourth day. Well, this particular agent left the listing out there too long. Guess how many offers the seller had to review? She left it out there probably around 3 weeks, if I'm correct.
What was the price point?
I don't remember the price point. I forgot what she told me. But guess how many offers?
If it was in that 300 range, I would say at least 400, maybe. If it was out for 3 weeks, maybe 150.
Well, she had 80.
80? Okay. Yes.
She had 80, and I almost fell on the floor. And I was like, what? And she said that the listing agent left it out there too long. And in the seller's market, you can't do that. Right. You have to make some quick guidelines and because that's not really good customer service to the seller.
Absolutely, because in 3 weeks that loan could have been closed.
Yeah, that's true. So talking about that, in this market, should a buyer, because if a buyer hires an agent, most of the time they do not pay for those services. The seller would actually pay the commission. So in this market, would you suggest that a first-time home buyer find an agent to work with? And if so, what are some characteristics of a good agent? What should they look for when they go out to hire an agent?
Okay, I believe in any market, you should hire an agent if you're purchasing a home. And especially in this market where, yes, it's considered a seller's market, meaning more homes for sale than buyers. Right. An agent's job is to protect you in the contract, period.
That's it.
The driving around and showing you the house and going through, that's a courtesy that's provided, and it's become a thing because everybody else was doing it. So that contract, that piece of paper is absolutely important. In this market where sellers feel like, hey, I can put my house up for anything and I could do whatever, you especially need an agent to be there for you. So you need an agent that's going to be responsive, an agent that knows the area, that can come up with a market analysis of that area. You need an agent that specializes in the area that you're looking in. So those are some of the things I feel like is very important. You also need an agent that's resourceful, an agent that has lenders, an agent that has property inspectors, an agent that knows what's going on in the market, because what's going on now, sometimes the comparable properties, the comps, you heard about that on the other show, where it has to compare to the home that you're buying, the most recent 3 sales within the immediate neighborhood. Sometimes those are not catching up with what's going on in the market. So an agent that because they're not hitting the MLS or FMLS sites, some of them are off market. So an agent that knows that neighborhood, they'll know what's going on. So you need an agent that specializes in the area that you look in, an agent that's responsive, that's going to be attended to your needs, and one that's resourceful, has all the tools and the weapons you need to get that home under contract.
Okay, so that's good information. Let's see. Travis asked a question. Should I ask an agent how long they have been doing real estate?
Yes, you can. That's a great question to ask an agent. It doesn't necessarily mean that because an agent has less experience than another, that makes, you have agents that have been agents for 20 years, and because an agent, they have to have a license, and as long as they're renewing their license, they don't have to sell one house. Right. So the time that they're an agent is not necessarily important. Yes, you can ask an agent, how long they've been an agent. And if it's something where it's been a short amount, they will elaborate on that, because I do know some people in the industry, they may have been loan officers or appraisers and now they're an agent.
Okay.
Yes.
Yeah.
So look at the big picture. Ask as many questions. Another thing, ask as many questions as you want to ask. Don't feel like you're offending that person at all, because this is the major purchase of your life. If not, it's one of the biggest one, if not the major purchase.
Okay. How about asking how many closings they've had? That was his other question.
That goes along with how many closings. That's really not necessary in my opinion, but you can ask. Like I said, you can ask any question that you'd like to ask. I know real estate attorneys that became agents, and they know real estate front and back. They were a real estate attorney, but you might just be working with them on the first property. Here, understand this. And I can only speak for Georgia, I know, but I think this is around the world. Correct me if I'm wrong. An agent has to be, a real estate agent, realtor has to be sponsored by a real estate broker. And a real estate broker has to have at least 3 years experience in the industry in order to be a broker. So they're going to be, they have people that's going to watch over everything that they're going to do.
Right. Yeah.
So you can, rest assured that you'll be in good hands. You just need an agent that's going to be responsive, especially in this market. You can't have an agent that you can't reach for a day or two. That house is gone.
Yeah.
Right.
Yeah. I had a client, and before I could meet her so that we could go view the house was gone.
Yes.
Right.
Yes.
And
I'm hearing a lot of that.
Then I had another client that said, I don't want to be in a bidding war. And I said, you don't want to be in a bidding war. You're talking about I was like, you're in nothing but a bidding war.
Right.
You're in a seller's market. And I think sometimes it's the mindset of the buyer, or the client, because it could be
correct.
Just trying to break down that mindset. I think I totally agree with you. I think your agent should be very attentive, and again, work on your behalf, right? Great customer service, but it's supposed to be all about the client.
Correct.
Right. And trying to get them the best deal. And
I definitely want to highlight, a lot of people think that if I don't have an agent, my price is going to be different. No. The price that the seller has, their marketing costs are already built into the asking price. And if you have an agent, great. Then the agent will get a portion of that marketing fee. It's already set aside. If you don't have an agent, then the agent that lists the property gets it all.
That's right.
They split it the person they split it to buyer's agent. So you need to use that to your advantage.
Yeah. And the other thing the viewers need to understand is that if a seller has an agent, that's called a listing agent. If the buyer has an agent, that's called a seller's agent, right?
Correct.
Now, if you go into a deal without representation and the seller has a listing agent, that listing agent works for the seller.
Correct.
They do not work for you.
That's correct.
Right. So their loyalty and their liability is to the seller. So, because they shy away from dual agency, right? Because you cannot get the seller the best price and then get the buyer the best price in one transaction, one person. You can't do it, right?
Right.
Because
you can't serve two masters,
you
right?
can't serve two masters, right? So, I tell everybody that, majority of the time, 98% of the time, you're not paying for that selling agent commission, right? Like you said, the seller has already built it in to their marketing costs. And so the seller is paying your agent to bring you there and to work the deal. So
correct. Correct. And that's another thing about an agent. I did have a client recently. They say facts tell, stories tell. So recently had a client, not making any disclosures. Okay, so let me see how I can do this. Okay, so I had a client that had an agent that was not attentive, was not the best agent. Okay, and that's not my job. I'm here to just bring the money to the closing table.
Right.
And the agent was not attentive, and it got to the point where I had the listing agent calling me, pressuring me to get the buyer to hurry up and do the inspection.
Wow.
And come to find out, when she did do the inspection, the house needed too much for her. She was buying a home for herself, and she didn't have any extra. She was already paying extra over the asking price, and then she didn't want to be putting a lot of money into repairs. But I said all that to say, there's under no circumstance should I have an agent, a listing agent calling me. They should be calling the buyer's agent, and they couldn't reach buyer. They're calling me. So I'm assuming that's what happened. But that's why I said it's very important to have an agent that's very attentive to protect you in that contract.
Right. Okay. So you wear a lot of hats. So the next thing I want to talk about is, how can I say this? Okay, so what is the difference between a lender, a loan officer, a loan originator, and a broker?
Okay, great question.
For
mortgages, right. So basically I have a sponsor and broker, and I work in the broker world. So I'm a mortgage loan originator. I originate mortgage loans. Okay. And as a broker, when you're a loan, you could be a mortgage loan originator or a loan officer. It's pretty much the same thing that you're doing. Just depends on, it's a preference of what you want to call, but the official title is mortgage loan originator. If you are originating mortgage loans, you're talking to clients and you're taking applications, you're collecting your information, then you're a mortgage loan originator. But some people call themselves loan officers. The biggest difference is going to come between a mortgage lender and a mortgage broker and a bank. Okay. A bank / credit union. The banks and the credit union, they're federally chartered. The loan officers that work there, they don't necessarily have to be licensed loan officer. They just need to be registered, right? Because and they can work in all 50 states for the most part. A mortgage loan originator that works for a lender, they basically are representing that lender, whatever products and whatever rules that lender has, that's what they have to adhere to. Okay. A mortgage broker a mortgage loan originator or loan officer that works for a mortgage broker, what a mortgage broker does is they work with several banks, several lenders. And so if they go to one company and that they can't get the loan done at that company, then they can go to another company. Whereas if you're with a lender and the lender says, we can't do this loan, that's it. The loan is declined, right? Right. But if you're a broker, you can try somewhere else, and they don't have to repull your credit. They'll use the same credit and things like that. So I've worked in both capacities. Right now, I'm in the broker world where I can work with several lenders, and I enjoy it more because there's you work directly with the lender. So what it does is it reduces the fees because there's not a lot of middle management to pay for. It also reduces the time. So you got. I had a loan clear to close in 6 days last week.
Wow.
Yes, 6 days. Yes, 6 days. And the reason is because I got the loan done without needing an official appraisal. It just used the automatic generated appraisal. And then lower fees. And lenders, their fees have to be uniform. They have to charge it. For a broker, if they use a processor, then the processing company will have a fee. But if they process their own file, then there's no fee. So that's the biggest difference. A broker works with several different lenders. A lender has their product. And if you're a mortgage loan originator or a loan officer, you're either working for a lender or a broker.
Okay, lender or broker.
Yes.
Okay, all right. A mortgage broker can actually shop for the best deal, and then the lender is, you have to go by the guidelines of that particular company.
Well,
Correct?
the lender has their particular products that they offer,
Yeah.
correct? And
Mm-hmm.
sometimes, you speak of guidelines, pretty much everyone gets their loans from the same places: Fannie Mae, Freddie Mac, which is conventional loans, USDA, VA, and FHA. Those are government loans.
Okay.
So they all have their own guidelines. Some lenders have what are called overlays. That particular lender may, a lender, the guidelines might say, okay, you can go down to a 500 score, right?
Mm-hmm.
But the lender is not comfortable with that. They're like, hey, we want to minimize the risk because we don't want to be buying back loans or whatever it might be, or we don't want to get a bad score and not be able to originate government loans, whatever it might be. And they'll say, you have to have a 620 score to
Okay.
apply with this company. So that's why sometimes you'll see a difference in different lending institutions where the minimum score might be different or the threshold for debt might be different.
Right.
Or you hear someone got declined at one lending company, go to another. That's because sometimes the company has overlays. They have an overlay of guidelines on top of the guidelines. As
Okay.
a lender, yeah, and as
Okay.
brokers don't usually have that. Brokers don't originate. They originate the loan, but they're not responsible for disclosing it. They let whatever lender they go with, they let that lender do all of that.
Okay. Now you mentioned Fannie Mae and Freddie Mac. Can you expound a little bit on those two?
Fannie Mae and Freddie Mac, basically they insure the loans that are lent out. So they're referred to, they're conventional loans, and they insure all the conventional loans. So basically, if a loan becomes if it goes into foreclosure, then the lender, okay, will put the house up for sale for foreclosure, and if they lose money on the house, then they can go and get Fannie Mae and Freddie Mac to pay the difference on that loan.
Okay. Okay. And then FHA. Let's talk about a little bit about
FHA is the same. It's the Federal Housing Authority insures the loan. It's a government loan, just like USDA. USDA and FHA are similar, except USDA, you're buying in a USDA territory, which is specific to a location of wherever the property is, and it's typically in a farm-like area, like in a boondock somewhere. And so the difference between FHA and conventional is that with FHA, you typically don't have to have as high a credit scores as you would a conventional loan, and your debt to income ratio could be higher than on a conventional loan. One of the biggest differences that some people don't like about FHA is you have private mortgage insurance. So anytime you put down less than 20% on a house, you're going to have private mortgage insurance, which is what protects the lender in case of the loan goes into default, right? That's that insurance, the pool of money there, right? But you have to pay it. So a lot of people, to avoid private mortgage insurance, they'll put 20% down on a conventional loan. But with FHA, it doesn't matter how much you put down, you're going to have private mortgage insurance on that loan for at least 11 years or for a lifetime. And what makes a difference is if you put 10% down on an FHA loan, it's 11 years. But if you put, if it's not 10%, if it's less than 10%, then you're going to have it on for the life of the loan. They are loosening that up right now to kind of compete a little bit more with the conventional loans.
Okay.
But I haven't got the official word yet.
Okay. That was good information. Okay. So, so when considering speaking to a loan officer, a lender, or broker about purchasing a home, what are some things that the viewers need to ask?
Say it one more time. Sorry.
When you're looking to where you're shopping, mortgage lenders, brokers, whomever, to get a loan to purchase a home, what are some questions that they should ask that person? Loan rate. What are some questions they should ask?
How much of the closing? What you're looking for is how much of the closing costs and how much is the interest rate, because that's going to affect your payment.
Okay.
Again, like I said, most lenders get their loans from the same place anyway because they're insured by those big institutions.
Okay.
So what you're going to ask is, first of all, if they have a program for you. So usually in the interview, the loan officer will say, okay, what are you looking to do? And they'll tell you you'll tell them what you're looking to do. I'm trying to buy my first home, or I'm trying to buy an investment property, and
Mm-hmm.
and you give them an idea what your credit score might be. Let them know you have student loans, because student loans are configured a little differently. And so the questions you want to, when you're giving those answers, the questions will be: do you have a program that will fit what I'm looking for? Do you do VA loans? Hey, I want to buy USD. Do you do USDA loans? What's your interest rate? Things like that. Do you offer any programs to help with down payment? We don't see anybody doing that nowadays with this market, but
Yeah, no.
but as a veteran, that is one of the best loans you can have, because it's $0
Yeah.
down. Okay. And you get it just by being a veteran. You can buy a property anywhere, in the United States.
What are some things that you take into consideration when reviewing a loan packet?
I want to go back to that question. Another thing you want to ask is, are you a lender or a broker? That's important, because you want to know if that person that you're speaking with, if you feel like you might have a rocket situation, you might need to have someone that can work with multiple lenders versus just one lender. Yeah.
Okay. So you would think to go with a broker more versus a lender.
I won't say either or, because I'll be biased because I'm in a broker world.
Right.
You know what I mean? But that is important. If you're somebody that wants to shop around or whatever, a broker might be a better fit for you than someone that's a lender. So they all have their pros and cons.
Right.
I've worked in both worlds, and I mean, I think brokers are better. Hashtag brokers are better, but to each his own.
What about credit unions?
Credit unions are in the same category as banks. You got to consider this. A credit union and a bank, out of all the mortgage loans out there, they'll probably originate about 10% of the mortgage loans.
Okay.
Most mortgage loans are originated by a mortgage company. Over 70% are done by a mortgage company or a mortgage lender. And for a reason, that the banks, and the credit unions, they typically want you to have, basically, we call it vanilla paper, good credit, low debt to income ratio, meaning you have very little debt to income. Debt is what's on your credit report.
Right.
So they don't consider your light bill or your cable bill. It's what's reporting on your credit, which is typically any mortgages, car payments, student loans, credit card bills, furniture bills. That's what's on your credit.
Okay, so I'm glad you mentioned credit, because this is my next question. What we see on our consumer report is totally different than what a lender pulls, because it's more in depth. Let's talk a little bit about that.
Okay. It's more in depth, and it's also a different version of credit that we pull. When a lender or a broker, when they pull your credit, that credit costs money to pull. You can go on Credit Karma and get your credit for free, but it's limited information. And I think Credit Karma is only going to go down to one report. They do 2 right now, but I think it's supposed to be going to 1 soon. So yeah, it's a different type of credit. It's more you're right. It's more in depth, and the scoring will be different. So I've never seen somebody's Credit Karma or third party score the same exact score as I have.
Right.
I have. Now, when as far as a loan officer, mortgage loan originator, when you're applying for a mortgage with a mortgage company or a financial institution that originates mortgages, we're going to take the middle score of the 3. So if you have, we look at 3, mainly we look at 3 credit score: Equifax, TransUnion, Experian, and we take the score that's in the middle, not the score that's physically in the middle. Like if it's a 500, a 600, and a 700, your score is a 600.
Okay.
If your score is a 600, a 500, and a 700, your score is a 600. So the one that's in the middle, it's not adding all 3 and dividing it by, dividing it by 3. It's not the average. It's the one that's in the middle that we'll use. If you only have 2 scores, we'll use the lower of the 2 scores.
Okay. I've had several. I'm laughing because I was thinking of one particular client that I had in the past, and when they came to me about wanting to buy the home, I asked them just preliminary questions, and of course everything was peachy king and gravy, right? And I said to myself, yeah, but when I give you to a lender, it's going to come out. And every time that lender pulled that credit report and Kerry, it was like, I said, you didn't tell me about that. But how did she know that? Because she pulls a more in-depth
correct
credit report. So you can't get around thing. So when you go talk to a lender, tell the truth because they're going to find out either way.
Correct. So that's another misconception I want to clear up. Like the mortgage loan officer, the mortgage loan originator, whatever mortgage loan originator, loan officer that works for that institution, they're there to help you get a loan.
Right.
Okay. So you need to disclose because their job is to get the underwriter to say yes and be compliant. It's all about presentation. Just because you have a bankruptcy or a foreclosure on your credit or a judgment or a late payment does not mean that you cannot get a loan. Just because your score is a 580 does not mean you cannot get a loan. But we need to know those things up front so that we can look for compensating factors. Like what else can we do? We paint a nice picture for the underwriter to show that you have credit ability. You have the ability to pay back this mortgage. You have job history. You have income. You show a steady path of savings. There are other things that you have a lot of assets. You have this huge 401k, but you got a 600 score, but you should still be able to get a loan with, the least amount of money down if that's what you want. So you want to disclose that information. A lot of people are out there doing credit repair and getting bankruptcies and foreclosures off their credit. Know this, the lender will still pull it, even if it's not on your credit. Even when the loan officer pulls it, it's not on your credit. There are other things the mortgage underwriter, their job is to find a way to say no to this loan.
Right.
Okay. The loan officer is to make sure that underwriter says yes. So they're on your side. You have to disclose, but they are going to get them to say yes and be compliant at the same time. But there are things, they could pull that stuff up. So you don't want to put on that application. It says, I'm being honest on this application. It says right on the fine print. Yeah. And they ask you, have you had a foreclosure in the last 7 years or bankruptcy? And if so, what type? And if you put no, because I cleaned up off my credit, and then it shows up in underwriting later, that's a decline.
Yeah.
Or that's a hurdle that is very hard to jump. Whereas if we put yes, it's not on the credit, your score is high. Great. You get in with that high credit score, it's on your credit. Oftentimes they just need an explanation and they just need to see where it's been discharged. Right. So it's very, very important to be upfront. Or here's another example. You don't want to waste money on a property and going on a contract, paying for an inspection, paying for an appraisal on a program that says, you need to be out of that foreclosure for 7 years versus you could have went another program where you only need to be out of it for 2 years. Right. Now you wasted all this money for that and you can't get the loan, or you got to start over with a whole nother loan, and get a whole nother appraisal. So definitely full disclosure. And one more thing, the credit that you do see, consumer credit that you're pulling, that is for if you want to buy a car or buy some furniture. Those scores are good. They'll match up. And it's a good guide to see what's coming on and off your credit, but it's not the same credit for mortgages.
Right. And you mentioned credit repair, right?
Or restoration. Yeah.
So let's talk a little bit about that. Has it ever been a situation where someone paid a lot of money to get their credit repaired by a company, and then you pulled the credit report and you still found the things that they said that they had taken off?
Well, yes. Well, they wouldn't tell me that because, of course, they want me to look at clean credit. But absolutely. Because here's the thing, especially with collections, they could be sold over and over to different companies. People have a misnomer. Oh, after 7 years, it falls off. It doesn't have to automatically fall off. Right. And there's a lot of things you can do to stay on top of your credit and clean your credit up yourself. And in your defense, in people's defense, a lot of information on the credit report is inaccurate. So, you do the ECOA, not ECOA, the Fair Credit Reporting Act of 1964 does allow you to challenge anything on your credit. So even if it was yours, that person may have a debt in collection, but they may not have a valid, they may not be able to validate that debt that's on your credit report. So credit report is not, a lot of people say, oh, it's illegal. It's not, if it's done, you have a right to challenge it. But again, there's a lot of people out there claiming that they can take this and that off your credit. What they can do, you can do. You just need to have the knowledge to do it. But yes, it can come up. It can come up again on a credit report. And mainly, not the collections of judgments, but mainly it's the foreclosures and bankruptcies that we can pull, even if it's not on the credit. And if something does pop up on the credit again, and that person paid for credit repair, that's because it was sold to another company and it got they didn't do it right. They didn't take it off properly.
Correct. So the moral of that discussion was a lot of times you can do it yourself. one thing is that it is timely, it's time consuming.
Mm-hmm.
And if you just take the time to do it and learn how to do it properly, you can do it yourself. So save yourself some money.
Absolutely. And if you got the money to flaunt it, go ahead, but make sure you check up on what the person is doing. I always say fix your mind, not just your credit. You know, we are where we are today because of the decisions we made 5 years ago.
That's
so just
true.
because you pay somebody to get that collection off your credit doesn't mean you're not going to go back and, well, how did you get into that collection in the first place? Like you said, it's a mindset. Oftentimes, for something to go to collection, that means you ignored it. Do not ignore your creditors. Creditors they just want to get their money. They will put you on a payment plan.
Yeah.
You know, whatever it might be before it goes to collection. So fix your mind, not just your credit.
Right. So what about judgments? What about court judgments?
All that is in line with collections. Yes. Foreclosures and bankruptcies are the main public records that are the issue that we will see. Now, judgments, it may not come to us, but let me tell you about judgments. I'm seeing clients getting taken to court lately. You know, back in the day, they used to threaten, I'm going to take you to court. They don't. Oh, they taking clients to court.
Oh, wow.
So you better stay on top of that judgment, and they're garnishing people's wages.
Yeah.
So you wait for your $1,000, $1,500, $2,000 check, and it's $500 because of, you know, so definitely pay attention to your bills. A lot of times if you have dings on your credit, you know, if it's not yours and needs to be removed, great. But yeah, judgments, be very careful with those. You can still get a loan with them, but sometimes they will take you to court. And I want to make one comment about the difference between a charge-off and a collection. A charge-off means that creditor is no longer attempting to collect that debt. A collection means they're actively trying to collect that debt. So oftentimes with our loan programs, if there's a charge-off, we ignore it, and we don't require it to be paid. Okay. So a lot of people might be like, I'm gonna buy a house, I'm gonna pay this off and pay that off. Sometimes you can hurt your credit by paying something off. So here is my advice. When you think you want to buy a house, you need to contact a loan officer, mortgage loan originator, the same thing, and you need to get a credit analysis. I'm looking to buy a house within the next 6 to 12 months. I want to see where I'm at, and get the advice from them, and they'll let you know what you need to do to be prepared for that. That's at least that's what I do for clients. Right. You know, if they're not ready at that time, because most people don't think about their credit until they want to buy something, right? Right. So, you know, if at that time they come and they're not ready, I'll say, listen, you're not ready right now, but here's what you need to do. Here's what you need to do to get credit. I also have people out there that are afraid. Let me tell you, if credit is there's 3 main things we look at when we're looking at a loan: your credit, your income, and where your down payment is coming from. Okay, depending on what program it is. If you don't have any money to buy a house and there's no program out there, you're not qualified for VA or USDA, you just have to get to the point where you can save some money or get gifts or whatever, right? So you can buy a house. Okay. If you don't have a 2-year job history, or if you don't have income you can prove, like you had a job but now you're self-employed and you don't have 2 years where you can average out your income or your part-time income, then you just have to wait till you have that history, right? To do that. But if it's your credit, anybody can buy a house within 12 months because you could do what you need to do to get that credit together to buy that house, or at least 24 months, depending on if it's a bankruptcy that's on that credit. You know, anybody can get that. A foreclosure, is 3 years out. There are programs that you could be 1 day out of bankruptcy or foreclosure, but just understand that those are not your typical programs. Those programs, you're going to need a whole lot of money down, 20 to 30%. And some people have that. And your interest rate is going to be a little higher than normal. Right.
So the main takeaway is when you're thinking about purchasing a home, before you do anything, just get a financial analysis from a mortgage lender, a mortgage broker, and allow them to tell you and give you a guide. Yes, things that you need to do.
A path. I call it a path to home ownership.
A path to home ownership. Okay, Rebecca has a question. She says, if something has been charged off, can they be removed from your credit?
Correct. Anything that's on your credit can be removed from your credit. If that creditor cannot validate that debt, you do have a right to dispute anything that's on your credit report. Right. If it's a charge off and it's on your credit, like I said, we don't require it. In most cases, we don't require it to be paid or removed. So if your score is high enough and that charge off is there, It doesn't matter how much it is, we can still do the loan for you.
Yeah, and a couple of weeks ago, we had probably around 3 weeks ago, we had a financial advisor on.
Okay.
And even when during her interview, she mentioned that sometimes closing accounts could go against you. And
absolutely.
she was saying that, when you're looking to purchase something, it goes back to what you just said. Before you do anything, talk to someone.
Correct.
Get that person's advice on what you should do. It was January. 3 months before then, I think it was 4 months before then, I had a young lady who had, she's a lawyer, and she had huge student loan debt, right? And so she graduated from school. She got a good job, right, in her field, but her credit score was low. So I gave her three lenders, and she called them. And just so happened, all of them told her the same thing. So I said, okay, well, if 3 people told you the same thing, then it's good, right? And so what they did, they told her that they put a plan together and gave her some suggestions on different things that she could do to raise her credit score, right? And so after 6 months, she did exactly what they told her to do. And at the end of January, she is in a brand new home.
Yes.
Because she followed the plan that the mortgage people put together for. So,
absolutely. Absolutely.
That's a good example of, if you would just listen and do what they tell you, you can have your dream home, you can have the things that you want, but you got to listen.
Right. So some people, they listen, but they listen to the wrong source.
Yes.
Programs change all the time. So Betty and your friend, and they may have gotten into a house a certain way, but that's not available anymore, right? So that's why you want to call and speak to the loan officer, the person that's there working every single day. And the reason why you get different results that way is because, first of all, we're using the mortgage credit, and second of all, we look at credit all day, every day. We see what could drop a score, what could raise a score, and things like that. And we take as loan officers, mortgage loan originators. Okay, that's a main difference. So when you're working for a mortgage company, you have to be licensed, and every year you have to take continuing education. That's not necessarily so for a bank. I'm not saying anything bad about loan officers at bank. I know some really brilliant loan officers that work for banks and credit unions. However, they don't need to be licensed, and they don't need to do all that continuing education because their bank is federally chartered. They take on all the risk, and they're responsible for training them. But as far as loan officers out here with lenders, we have to get continuing education every single year. We have to be licensed, and we have to get continuing education every single year. So as things change, we keep abreast with all of that.
Right. Now that's good to know. Now let's talk about debt to income ratio. Can you give us the definition of that?
Yes, your debt to income ratio, it's right there. If you ever take a test and be like, what's the answer? It's right there in the question. What is debt to income ratio? How much debt do you have compared to your income? Right. And you want to keep it at a threshold. If you're looking to purchase a home, first of all, what is the debt? I went over this earlier. Your debt is any kind of mortgage. A debt is a mortgage payment, anything that reports on your credit report, car payments, student loans, credit cards, furniture bill. Those all report on your credit report. Collection account is not necessarily in your debt to income ratio because it's a collection. Okay. If we decide that, if you qualify where you don't have to pay that collection, then what we will do is take 5% of that outstanding amount. So let's say it was $1,000. We take 5% of the $1,000, and that's your payment. So that's how we'll get into your debt to income ratio. But sometimes you're required to pay the debt off. You will pay the debt off at closing. You don't pay the debt off before. So you pay it off when you get your key. You verify you had the funds to pay it, right? Right. So that's what your debt to income ratio, anything that's reporting on your credit. There's some debt that's not on your credit. That's part of your debt to income ratio, i.e. child support and alimony. Some people have child support and alimony that's coming out of their paycheck. If your car insurance is coming out of your paycheck, that's not considered debt because we don't consider utilities and car insurance part of your debt. But if your car payment is coming out of your paycheck and it's not reporting on your credit report, it's like one of these buy here, pay here, lots of something, and that's considered debt. Right. Okay. So if it's reporting on the credit, that's fine. We don't double dip. We don't say, it's coming out your check. We don't do that. If you have a 401k loan, used to be when you had a 401k loan, that was part of your debt to income ratio. that is no longer part of your debt to income ratio. You're borrowing money from yourself. It's your asset, right. So we don't count that against.
That makes sense.
Right.
That makes sense. Yeah.
So when you add all that up together, there's two things we look at. It's called a front end and a back end debt to income ratio.
Okay.
The front end, simply put, is how much is this house going to cost you? It's the housing expense. The money you borrow, which is the principal and the interest, that payment, plus the cost of the property taxes and the homeowner's insurance.
Right.
And the homeowners association fee on a monthly basis. What is that amount? That's your front end ratio. So they're going to say, let's say it's $2,000 a month and your income is $6,000 a month. Then your front end ratio is 33% because 2,000 over 6,000 is a third. So 33%. Okay. On the back end, on top of that 2,000, you had another $1,000 worth of bills. So your back end ratio, that's your debt ratio, right? So you got the housing ratio, that's the front end. The back end ratio is your housing plus your debts that we just described on your credit. That's another $1,000, so that's $3,000 over the $6,000. So that will be 50%. So we'll say your debt ratio is 33 over 50%.
33 over 50.
You have to qualify for both.
Okay.
You have to qualify for both the front end and the back end. And in some cases, somebody don't have any debt, so their front end and back end is even. So if your front end is 50% and your back end is 50%, you're gonna have to drop down on how much house you can buy because that's too much. Because you wait on the front end, you want to be no more than about 33%. On the back end, you want to be no more than 50%.
Okay, so
you can go a little higher for something like FHA loan, but you don't want to be more than 50%.
So someone with no debt can buy a house?
Yes, as long as they have a credit score, you can buy a house. Okay. Absolutely.
Okay, that's good. No, okay.
So this means your front and back end going to be the same.
So Rebecca made a statement. She said, we worked hard to pay off our 30-year mortgage in 20 years and were hit with a large point drop in score automatically. We had no idea that would
be seen as negative.
Negative.
First of all, congratulations, you paid off your mortgage. Woo! You leverage money from a bank to get yourself a house that's grown in over time, which you paying it off. Plus, you got some money grown because you owned it. Yeah, equity, great. Don't worry, your score is going to go back up. The reason why it went down because you closed out your history. Right. 35% of your credit is how you pay your creditors. Are you on time? Are you late? You have charge-offs or collection. That's 35% of your credit score. 30% of your credit score is, are you maxed out on your credit? Are your credit cards maxed out? Like, you owe $8 for every $10 that you have available to you. That's 30% of your credit score. So that we have 65% of the credit score. How you pay your bills and the how much you owe to your limit. And then 15% is your history. That 15% comes when you close an account. Okay, it's going to go down, but it's okay. It'll go back up. Go back up, and it may have dropped, but if you have other types of credit, a good mixture of credit, it shouldn't drop that significantly where you can't get anything. So I wouldn't worry about it. You got rid of that debt, honey. Because if you look at that word mortgage, like I said, I'm doing this because I'm putting people in good debt. I'm putting them in a debt where the asset is going up. It's not going down. Mortgage, mortuary, death. Gauge, engage, grip. You got rid of that death grip. So celebrate. But that's a great question. But your score will go up. It's just that your history is gone, and that's 15% of your credit.
Okay, quick question. So what does closing costs consist of?
Oh, great question. Closing costs. Wow. So closing costs is the cost of closing the loan. So you have the purchase price of the house, and then you have the cost of doing the loan. At the end of the loan, you get what's called a CD, a closing disclosure. And on there, it's like a receipt. Everybody that had to do something with that loan has to get paid. So that's part of your closing costs. Some lenders have processing fee to process the actual transaction. Then you have the underwriting fee to underwrite the loan. Those are going to be your two main lender fees.
Okay.
Sometimes you don't see them because, brokers don't. Sometimes they could, brokers can build it into the price and they have an option to have a processor. Then you have your attorney fees. You need an attorney in some states. I know for the state of Georgia, I'm licensed in Georgia and Florida. So in Georgia, you need to have an attorney to close your loan. So that's an attorney fee. Then they have to examine the title. So they have to make sure nobody else has access to this house or there's no extra liens on this house. When you buy, it's free and clear. And then there's title insurance, just in case the ex-wife or the child of whatever comes and say, hey, this is my house and you've been in this house and there has to be a claim, then that's title insurance. That needs to be paid. And that's for the lender, actually. Okay. That protects the lender, but you pay it, right? And then you can opt to get your own as well. It's called owner's title. And then you have, so those are attorney fees. Then you have government fees. The government always got to put the tax on there. Yeah. And we have two. We got the transfer tax, which is 1% of the value of the property. And then we have the intangible tax. You can't even touch it. It's intangible tax, Georgia intangible tax. And that's 0.003 per $1,000 that you borrow.
Okay.
So when you add that up, that's your closing cost, right?
Okay.
Then you have, depending if you put down less than 20%, then you have to escrow. You have to set up an account where your taxes and insurance are set aside. So they got to collect that money up front. That's part of your closing costs as well. So you'll sometimes see on your paperwork closing costs, and then you'll see prepaid items. Those are your escrows and any prepaid interest, or if you have to buy homeowners insurance, they're typically required to prepay 1 year up no matter what. And that's all part of your closing costs.
Okay. So Johnny has talked to a loan officer. Johnny has found a house, and now the loan mortgage process has begun. What are some things that Johnny could do to terminate that loan? Some things not to do.
Oh, to terminate the loan, like meaning get the loan declined, or he wants to just get out the loan. Oh, Well, one of the things I send out here, I always send out congratulations on your pre-approval or your loan commitment. These days I'm doing a lot of loan commitments because pre-approval just ain't enough. And I say do's and don'ts. Do not go out there and buy anything out of the ordinary. Don't go buy a new car. Don't go co-signing for somebody. Don't take out that school loan for your child. Let your child take out a school loan on their own because you're about to buy a house. Do anything after the house. Basically, you don't want to buy anything. You don't want to have large deposits going into your account because you're gonna have to explain where they come from.
Yes.
And sometimes it opens up a can of worms, right? Like, okay, it came from this account, but this money is not, things like that. So you don't want to go closing accounts. Oh, I'm gonna pay this off and close it because, typically sometimes the lender does have to repull your credit.
Yeah.
The underwriter may require a new credit pull for whatever reason. If they repull that credit, you close the account and 15% of your score is your account. Yeah. Your score just dropped. So those are some things that you definitely don't want to do. You don't want to spend your down payment on that funeral. You don't, because that's one of the top ways that loans get declined. Don't go transferring money. Yeah. Don't take money from your mattress and put into your account. Right. Yeah. Don't bounce any checks. Don't be late on it. Your account is actually hostage. When you do the application, you're gonna fill out a loan application as completely as possible. Name, address, date of birth, social, where you work for the last 2 years, where your down payment is coming from. Do you have any stocks, 401k, checking, savings, and have you had any bankruptcies or foreclosures? Have you co-signed on a loan? Are you married or divorced? Are you, all of that? And then everything else, all your documents have to back up what's on that application. Correct. Right? So the loan officer is going to collect it. The processor is going to process it. They're going to verify your employment. They're going to do all these other things. Then the underwriter is going to underwrite to make sure all the T's are crossed, all the I's are dotted, and they're going to try to figure out a way to make sure this loan doesn't get closed. Not to be mean, but they're there to protect the lender against loss. Right. And if anything changes or anything is not the way it was presented, yes, you could have a problem because they have to redo the underwriting. So those are some of the things that you definitely don't do.
And they want to make sure that you're a good risk, right? Because they're not loaning you $10. They're not loaning you $100. Correct. They're loaning you hundreds of thousands of dollars. Correct. And so they want to make sure that you are a good risk. And like you said, what you have on that loan application has to match those documents. And when they don't, like you said, or don't give them a reason to say no.
Yeah, don't go buy a new car because I'm going to buy a house and do not buy anything. Don't
buy anything.
You can buy that smoothie from Smoothie King, but don't buy the car. Don't buy none of that. Don't create a new furniture bill. None of that. $50 can make or break a loan. I've seen it. I've seen a $50 payment. I have seen a $50 payment pop up in someone's bank account that was not disclosed on the credit. They owed IRS money. See, IRS is no longer, if you owe IRS money, it no longer is on your credit report. Right. Okay. And if you're a W-2 wage earner, we don't need tax returns. So this person owed the IRS money and set up on a payment plan with the IRS, and they just and never disclosed it on the application. And $50 was coming out of the account. The underwriter caught that.
Wow.
And that loan was it was about to be a decline, but they had to find the $4,000 to pay it all off. So
wow.
Yes.
Yeah. So you need to be upfront.
You need to be upfront, yeah. And in that case, this particular bar they didn't realize it. I mean, they knew they owed the money, but they didn't know that payment was going to kick in like that. They didn't know it was going to be an impact, So yeah.
Right. Well, that's why people need someone as knowledgeable as you, so that when things happen, look, you already know. You've worked some deals.
Yes, we've worked some deals together. Yes, we've done some. Yeah, we worked some deals, and we've done some stuff like out the box too.
But some that almost caused me and you after the closing to go get a drink, and I don't drink.
Exactly. But we end up at Panera Bread instead. Yes, and we were safe. But yeah,
you have some people say, look, you have some people saying, and but God, because I'm telling you some of the things that me and you have done. I'm like, wow.
I think it was an attorney that was like, what are y'all trying to do? And we got it done. We twisted the arm for them to do it. But yeah, definitely.
Yeah.
Definitely. But that's my motto. And that's why I like working with you, because it's like you had the same, passion and drive. So I'm always honored when you're like, hey, I got this deal. I'm like, yeah, I'm about to get, she about to put me to work. But, they're not all like that, but you know what I'm saying? When we have something, I always believe in a solution to every problem.
Yeah.
There's a solution to every problem.
Yeah. The step. Yeah. The step. Well, Kerry, thank you so much. I really appreciate you saying yes. Viewers, if you need to talk to Kerry, her information, we're going to put it up right there. You go. We're going to put it up right quick. You can reach her on email. She even gave us her office phone number and her Facebook address. You can reach out to her. If you leave her a comment today or a question, give her 24 hours and she'll get back with you. She promised that she would.
Oh yeah, absolutely.
Yeah,
absolutely.
But Kerry, thank you. Thank you for all that you've done for my buyers. Thank you for educating me. I am a better broker. I am a better broker because of the knowledge and the things that you shared with me. So I just really appreciate that. I really do.
Thank you for having me on, and thank you for doing what you're doing. And I just pray that any information that we've shared today, it can be of some value to you out there. Don't be afraid to ask. There is no question. I don't care if you think, oh, that's a stupid question. You ask that question. We love to answer questions.
Right. And then this is a living video, right? So people can we covered a lot of information. Replay it.
Correct.
Re-listen to it, because you gave us a lot of good information.
Yes.
I just want to tell everybody, thank you so much for joining us. I am Tina Dawson, the owner of True Blue Designs, and we will see you next Wednesday, same time, same place. You stay there. Hold on.
Yes.
Goodbye, everybody.
Bye everyone for now.